Hi, we're going to start Chapter 2 today. We're just going to go through some of the cost terms that we will be utilizing throughout the different chapters of cost accounting. Hopefully, many of them will be familiar to you because you learned about them in Accounting 4A. So I'm just going to turn this over and we're going to get started. All right. When we're looking at financial accounting, they are more concerned with expenses. Those things, accrual accounting, that occur as far as being needed to pay in order to help us to earn revenues. In cost accounting, I think I'm going to have to find a pen that writes better. Just a second. Try this one. In cost accounting, we're looking more at costs. Well, a cost outlay is like an expense, something that we are paying for. And so what happens as far as what we're looking at, it's a past, present, or future cash outlay. And so a cost outlay is going to basically be at some time a cash outlay. But in cost accounting, we're also looking at what we call opportunity costs. And an opportunity cost is not a cost at all. An opportunity cost is really lost revenue from choosing one alternative to another. So it's lost revenue because of the choices that we are making. It is the lost revenue because of a choice, a decision. Think of it as like a lost benefit. So I'll give you an example. All right, all of you probably have an opportunity cost. Many of you choose to come to school rather than getting a full-time job. Well, the money that you don't get by not working full-time is an opportunity cost. You have foregone revenue or income now, hopefully to make more money with a better job in the future. It's the same thing with people who are working full-time but going to school part-time. You have an opportunity cost. Your lost benefit might not be in dollars, but it would be in time that you could do things with your family or whatever extracurricular activities you like to engage in. You just don't have that time anymore because you're trying to go through and get then an education, like taking our cost accounting chapter and exam class. Okay, so what we're looking at then now is we know that there are basically, and maybe I should have put that down, there are basically three types of for-profit businesses. They are either a service business, a merchandiser, this is either a wholesaler or a retailer, and then there of course is a manufacturing. Manufacturer. Well, we all are interested when we do an income statement for any of them. It's basically revenues minus expenses. But we know that the service business is probably the simplest kind because their revenue comes from whatever services they provide. So it could be a gardener. That is a service business. They come, they do the gardening at your home So the revenue is from their gardening services. Their expenses would be for gasoline, repairs on their equipment, depreciation on their mowers and edgers, but basically a simpler type of income statement. Merchandisers, wholesalers, and retailers basically are those people who have cost of goods sold, but the goods that they sell, they have purchased the same way that they are selling them. They might put them in a box or put some ribbon on them, but basically they're in the same condition that they bought them from the manufacturer. So what we're looking at basically is we're going to be looking at manufacturing companies in our cost accounting class because that's where cost accounting has its most emphasis because of the variety of things that we do. Because what a manufacturer does is they take a raw material and change it into a finished good that they then sell to the manufacturer, who either sells it to the merchandiser, either a wholesaler or for a retailer. So these are the kinds of companies that we're looking at. And of course, as we go from a service business to a merchandiser to a manufacturer, then the information on our financial statements become more complex. For a service business, we basically are looking at just our expenses, and we of course usually refer to these as operating expenses. The merchandiser has the operating expenses too, but they also have then the cost of goods sold. When we get down to the manufacturer, we still have our operating expenses. And remember, our operating expenses are our administrative expenses and our selling expenses. And I didn't write it up there, but that's true for the other two as well. And we also have our cost of goods sold, but we have to manufacture them. So what we're interested in a manufacturing company is not only, the cost of goods sold, but the cost of goods manufactured. And it's this part that we're really going to be talking about as far as a manufacturing company is concerned. A lot of the terminology that we utilize as far as a manufacturing company is concerned, because we do many of those same things. So we've got lots and lots of different kinds of terminology that we have to look at. And so I thought maybe we might possibly just go to about page 48 in the textbook and start talking about some of the terminology that we see as far as the company is concerned as a manufacturing company. Okay. So, two of the main costs that we look at are what they call product costs and period costs. Okay? And so we differentiate between our manufacturing costs as far as a product cost or a period cost is concerned. Now, a product cost is basically the material, the labor, and the overhead costs that we have in our product. And product costs are what they call, these are what we call then our manufacturing costs. And these manufacturing costs are what we also call inventoriable costs. And what that means is that these costs for material, labor, and overhead are in our inventory until the product is sold. So we could make something in 1 year and have it entirely completed, but not sell it until the next year, and so that product would remain in inventory until the product is sold. So basically we would have an outflow of costs, not expenses, but costs in 2020 for the material, labor, and overhead of this product, but they would be an asset to us in an inventory account until 2021 when we sold the product. And in 2021, we basically would not have any cash cost outlay for the material, labor, and overhead because we paid for them in 2020. But in 2021, we will have a cost of goods sold because that's when we are then going to be selling that particular product. So it's called a manufacturing cost, it's called a product cost, it's called an inventoriable cost, and I always think of this as something that you basically can incur just once. Because any product that we have, my favorite thing, a calculator, the cost to Casio for this, for the material, labor, and overhead in this one calculator can only be incurred once. Okay. Product costs are basically our operating expenses. Remember our general and administrative and our selling expenses. And period costs, as the name implies, these become expenses in the period incurred, they don't stay on our inventory, so these are our non-inventoriable costs. And basically we can incur each accounting period. So these are two terms that we're going to have to get used to as far as cost accounting is concerned. We need to know what our product costs and what our period costs. And these are both explained on that page 48 that we talked about. Okay. So we're just going to be looking then at these ideas, and we said that our product costs, I wrote up here, these product costs are our manufacturing costs, and they are made up of material, labor, and overhead. So when we look at our manufacturing costs, this is what we get to when we come out with that cost of goods manufactured. They are made up of 3 items. We refer to them as direct materials, and direct materials are any materials that they can be easily and directly associated with a product. So these are ones that can be directly traced to a product. Okay? So we're not talking about the little teeny tiny things on something. We're basically talking about the big parts, the ones that we can see that are then can be directly traced to a product, and we can do this economically. It means that they're not the little tiny things, but that's why we call them direct, because they can be traced to the product. The second component is direct labor, and its definition is basically the same as material. It can be easily traced to a product, easily and economically traced to a product. The third component of our product is then, we can call them different things, but basically this is our manufacturing overhead. And you know me, well, if you don't, you will. I love to abbreviate things. So I usually refer to direct materials as DM, direct labor as DL, and manufacturing overhead as O/H. It's going to save me a lot of writing as we go along through here. So what do we mean by manufacturing overhead? Well, manufacturing overhead is an indirect cost to the product. Okay, that means that we can't trace it directly to the product, probably because it is too small. But manufacturing overhead is basically all other manufacturing costs except direct material and direct labor. So if we're looking at some examples of our manufacturing overhead, one of them might be indirect materials. And indirect materials, you know me, get this pencil over here again, get the lid off, and I usually just do IM for indirect materials. And so some examples of indirect materials could very well be nails. It could be washers. You know, those little round plastic things that they put on things. Or it could be anything that is too inexpensive to bother tracing directly to a product. And I'm going to reach over here. I'm going to grab something, and it's going to look silly, but that's okay. You know me, sometimes I'm silly. I have a little clock here. Let's see if I can get it on here. Turn it around here so you can see it. It's just a clock. Okay? And so if I was looking at this clock, probably the wood frame of this clock is a direct material. probably this ring might or might not be. If I took the back off and the little motor that keeps it going is probably a direct cost, but that could very well be the only direct cost as far as my clock is concerned, because they probably buy these little buttons on the bottom. They probably buy them in bins of thousands at a time, and the cost of it for the 4 of them on this one clock, it would not be economical to trace that cost to this particular unit, this one clock that I'm looking at here. And it's probably the same way with maybe the face and the hands and the minute time that goes around. So all of those things, the little feet and the hands, and are probably going to be considered as far as indirect material is concerned. We could probably even cause these little Phillips screws that go in here. Those are obviously going to be some indirect material for my clock. Okay? And so we also have indirect labor as part of our manufacturing overhead. Okay. And again, when we look at my clock, okay, maybe it takes someone to take a piece of wood and cut out the shape of my clock from a piece of wood, and maybe that person that does that is probably a direct labor person for the clock. I'll try to keep getting the clock in the way here, okay? But when we look at maybe again, the motor that's in the back of it, the person who put that together, that's going to be a direct labor cost as well. Okay? But maybe the person that cleans up after the sanding has been done for this, that's going to be an indirect labor cost, because I can't trace their cost directly to here. And maybe some of the other parts that go on here are any kind of indirect labor as far as our company is concerned. So it's work that can't be directly traced to this particular, maybe the warehouse people, they are all part of our indirect labor. But then the last thing that we have down here is then that we want to look at as far as manufacturing overhead is concerned is all other manufacturing costs except indirect material and indirect labor. And so again, what kind of other manufacturing costs could a company have? Well, there could be factory rent, factory utilities, factory property taxes, depreciation on our factory equipment. Okay. It could very well be like a plant supervisor's salary. So anything that you can think of that a company needs to manufacture my clock that is not direct material or direct labor is going to show up then as part of manufacturing overhead. And in a while, let me just try to get my clock out of the way here so I don't knock it on the ground. After a while, when we are looking at how we charge costs to our particular products that we are dealing with, we'll find again that we can directly charge material and labor to our product, but manufacturing overhead is an indirect cost, and we'll find out later that manufacturing overhead is what they call an applied cost. Okay, and so we're not going to be able to look at them directly. So I can see in my clock, maybe I can see the cost of the direct materials, maybe I can see the cost of the direct labor, but I can't see exactly how much plant supervisor salary or property taxes or utilities are in my particular clock that I have as far as our company is concerned. Okay? So again, we're just looking today at, in this video, at some of the terms that we have as far as our cost accounting is concerned. We'll get into the good stuff in a little while. Okay, the computational stuff. Okay, so now I'm kind of on page, I've only gone one more, so we're still now on page 49 in our textbook, and they are talking about two other terms that we are looking at. And pretty soon we're going to find that we use different terms for the same thing depending upon the cost objective that we have. And so sometimes we take our manufacturing costs, hopefully MFG, manufacturing, so I don't have to write it out anymore, another abbreviation. We take those manufacturing costs, remember, direct material, direct labor, and overhead, and we sometimes call them by different names. And we refer to them as either prime costs or conversion costs. Okay? And prime costs are basically the main big costs. So our prime costs are simply, we just simply add up direct material plus direct labor equal our prime costs. Because those are the main ones that we can see in the product that we are looking at. We also sometimes talk about conversion costs. And conversion costs are those costs that basically are our direct labor plus our overhead equal conversion costs. And why do we, so obviously one can never add together prime and conversion costs because you're double dipping on the direct labor costs. But conversion costs are why they call them conversion costs is because we need direct labor and manufacturing overhead to convert a raw material into a finished good, or the product that we can then sell to something. So when we talk about this and when we get into looking at process costing, many times we separate our costs between direct material and conversion costs. Okay? So we've already kind of talked about non-manufacturing or period costs on the bottom of page 49, so we're not going to take those and take a look at those as far as taking a peek at those again. Okay, so again we're just talking about some of the terminology that we are looking at as far as a company is concerned. Okay? And so what happens is that we are now going to look at how we allocate then our costs, okay? And we've already talked about direct costs and indirect costs, and sometimes it goes along with the cost objective that we are dealing with. Okay? So before we do much of anything, we need to remember that as far as manufacturing accounting is concerned, for manufacturing costs, that we basically have three inventories that we will be dealing with. Remember, a service business probably doesn't have much of an inventory at all. They probably have supplies. So if they have some extra of those things that go on weed whackers, those are supplies to them. They're not inventory, because an inventory is something that we're going to sell to someone else. So a merchandiser just has one inventory. They have a merchandise inventory, and they put in there everything that they have that they are going to sell to their customers. But a manufacturer has three inventories. The first one is the raw materials inventory. These are any of our both direct materials and indirect materials that have not been used. That's kind of like our pantry at home with all that food in there we haven't used yet. The second entry is what they call work in progress. This can be work in process, work in progress, goods in process, but we're going to use work in process. And so another abbreviation for lazy me, WNP, work in process. And these are basically units of product that have been started but not finished. Anytime, but basically at the end of the accounting period. And the third kind of inventory they have is our finished goods inventory. And the finished goods inventory, it is just like your merchandise inventory in a merchandiser and a wholesaler or retailer. These are completed units that have not been sold. So again, the finished goods inventory is kind of like a merchandise inventory, because those are also goods that are ready to be sold that have not been sold as of yet. Okay? So these are basically most of the costs that we are looking at. Okay? Ultimately, and I'm trying to find it real fast so I can talk about it. We're going to get to that in a minute. But I know on page, I think it's page, what is it? I had it. It's our Exhibit 2-16, and I'm going to flip over here and take a peek at the page number that it's on. So we're going to look at a couple of other things. Sorry about this. I could have put it on pause, but I didn't. On page 66, there's kind of a summary of all of the cost terms with their definition that we're going over. So, in fact, I made a copy of it so you can see what I'm looking at. So here it is, and we just said it's on page 66. And you can see we've gone through cost, opportunity, expenses, product period. This full absorption is the one I'm going to talk about next. We've talked about direct and indirect costs, and then we're going to talk about cost behavior in just a minute. And remember that many of these things we'll come back to at a later time when we are utilizing them for the specific area of cost accounting that we are dealing with. Okay? What you've been used to as far as accounting for financial accounting, intermediate accounting, is you've been interested in this thing right here, this full cost absorption. And what happens with full cost absorption is what they are looking at as far as GAAP, General Accepted Accounting Principles. We don't always use full absorption. Costing. This a lot of times is talked about as far as direct costing is concerned. This is for financial accounting. And so it means that every product in full absorption costing has to absorb some of the material, the labor, and the overhead for each product. When we get to that chapter, we will be looking at direct costing as far as cost accounting is concerned. And so we're just going to leave that there as far as what we mean by full absorption. It simply means that every product has to absorb all parts of all types of costs as far as accounting is concerned. So this is what they're talking about as far as full cost accounting is concerned. Okay, so we've already kind of hit on page 51 the difference between a direct cost and an indirect cost, and we will definitely be coming back in more detail as far as the difference between a direct cost and an indirect cost. Okay. On the top, on page 53, then they start talking about what we've just talked about, but our Exhibit 2-6, if you look at that, simply shows that the store, the process, and the complete goods goes through a raw materials inventory, through work in process, and through finished goods, which is exactly what we have talked about right here. Okay. If you turn the page, they talk about cost of goods manufactured and cost of goods sold. And so we've already talked about the three kinds of inventory. We're going to leave it for the next video to take a look at how we determine our cost of goods manufactured. We kind of want to finish off a little bit. Let me see if I can find another piece of paper here. I know I have some. This is kind of like using Elmo at school, okay? And some of these things we'll come back to in a later time, okay? On page 57, they are talking about how costs behave. Okay? And when we get to a thing called CVP analysis, cost, volume, profit analysis, we will make the decision when we are looking at volume, as far as our company is concerned, we're going to say that we're going to make all costs either a fixed cost or a variable cost. Okay. So that we can determine then what's happening as far as our company is concerned. A fixed cost, now you have to excuse me, remember I'm not an artist, so if we look at a graph for a fixed cost, and this is the first quadrant, so everything is positive numbers. This along here is our y-axis, and this is our x-axis, 0. And along the y-axis, we are looking at the costs. And then on the x-axis, we're looking at activity. And a fixed cost, if that was a straight line, which we know it isn't because I'm not good at drawing straight lines, this is an example of what a fixed cost looks like. And what that means is with whatever the range of activity, the cost remains exactly the same. It could be something like your car payment. You have to make so much car payment every month. Does it matter whether you drive that car 1 mile, no miles, or 1,000 miles? No, you have to make the same car payment every month. And so if the activity were miles, as we increase our miles, the total cost of our car payment would remain exactly the same. So the fixed cost remains fixed. In total. Okay? So we're always then looking at fixed costs, okay, as far as our companies are concerned. Okay? So it remains unchanged as far as the volume is concerned. Variable costs intersects the XY axis at 0 and slopes upward and to the right. And how far, if it's pitched or low, all depends on the cost, and it also depends on the activity. A variable cost remains constant on a per unit basis. Okay. So that means like if you go to the store and you buy 1 bag of potato chips for $3, unless they have a deal going, you buy another bag, it's another $3. So every bag of potato chips you buy is $3. So as the activity goes, the slope of this line increases by $3 for every unit that we go along through here. Okay? So all costs ultimately have to end up being what they call either a fixed cost or a variable cost. Okay? So the other kinds of costs that we find lots of times is a cost that looks like this, and it intersects and slopes upward, but it doesn't intersect at 0. This is what they call a semi-variable cost. We're used to calling this a fixed cost from Accounting 4B. And a semi-variable or mixed cost has both a fixed part and a variable part. And when we look at the chapter in cost behavior, we'll see how we can separate a mixed or semi-variable cost into its fixed or variable components. Okay? But right now, all we have to say is we know what a mixed cost looks like. Okay? We have many, many different kinds of costs as far as how they behave. We can find a cost that looks something similar to that, and this is what they call a step cost. They look like a set of steps. And depending upon the width of the steps, we could make it maybe look almost variable or fixed, and that's why you'll read that we're talking about a thing called the relevant range. And I like to use this one, talking about the relevant range, because we have a relevant range on fixed, variable, semi-variable costs, and stair-step costs. But if we looked at this, and this was a plant superintendent's salary, which we remember would have been an indirect cost, it would have been part of manufacturing overhead. But if this is the salary of one supervisor, this is the salary of 2 supervisors and 3 supervisors. So we would have like the day shift, the swing shift, and the graveyard shift. You know, the person that gets to work 8 to 5 or 8 to 4, and this one works 4 to 12, and this one works 12 to 8, then lots of times our costs will go up. Well, if in our activity, our relevant range says always need 2 shifts at the plant, then our relevant range would be right there, because I know I'm never just going to have the salary of the day shift, nor will I ever have to hire a 3rd graveyard superintendent, but I know I will always have 2. So this step cost is a fixed cost, and the amount would be based on our 2 supervisors then together. And so this is what they are talking about. And so we've been at it for quite a little while, and we've gotten all the way up through page 61. And so we're going to let this go for our video and pick up with the rest of Chapter 2 and take a look at some exercises, multiple choice questions on our next video. So hopefully this explains some of our cost terms that we're going to be dealing with.